IBM just dropped their Q2 2026 earnings, and it is a solid beat across the board. Operating EPS came in at $2.93, which beat the street consensus, on revenue of $17.2 billion.
Right, and they actually raised their full-year guidance to that 4 to 5% range, which is huge.
Yeah, the market is definitely loving it. The stock is popping like 4% in after-hours trading right now. So for this deep dive, our mission is to cut straight through the corporate jargon of this earnings report.
Because there's always a lot of it.
Oh, so much.
Yeah.
But we really want to figure out if their massive, multi-billion-dollar pivot toward AI and hybrid cloud is actually generating real cash for you as an investor, or if it's just, I don't know, a very expensive construction project.
It really is the ultimate test of corporate reinvention. I mean, looking at the presentation slide deck and the press release, it's pretty apparent this is not the legacy IBM of the past.
No, definitely not.
The stakes here are entirely about whether a legacy tech giant can fundamentally rewire its own DNA in real time.
Okay, let's unpack this. The headline numbers, they are a bit of a mixed bag if you just glance at them. Like I said, Q2 revenue was $17.2 billion. But that's only up 1% year over year.
Yeah, essentially flat.
Right. And you have that operating EPS at $2.93, up 5%, but their GAAP EPS is sitting lower at $2.27. Though their free cash flow for the first half of the year was a really solid $4.8 billion. But just to clear the air right away on those EPS numbers, why is there a gap between operating and GAAP? We know our listeners get the basics, but it's worth a quick refresh.
Sure. So GAAP is the strict standardized accounting rulebook.
Yeah.
It includes absolutely everything.
Like restructuring costs and all that.
Exactly. One-time restructuring, acquisitions, the messy stuff. Operating EPS strips out that one-time noise to give you a clearer picture of how the actual core business is running day to day.
Got it.
And when you look at that core business, what's fascinating here is that the real story of this quarter isn't that sluggish 1% revenue growth. A flat top line usually worries the market, but
Yeah, it definitely raises some eyebrows.
the real story is the margin expansion. IBM's gross profit margin hit 59.4%. And even more impressively, their operating pre-tax margin expanded by over 30 basis points. It reached 19.2%.
I mean, I need to pause on that because when I see a company bringing in essentially the same amount of revenue as last year, but somehow making significantly more profit on it, red flags go up for me.
Naturally.
Like, are they just doing a corporate Marie Kondo right now? Are they just doing mass layoffs? Is this the standard playbook of cutting costs, slashing research, and, hollowing out the company just to force the profits up for the earnings call?
It's a totally valid suspicion, but the data points to a very different mechanism here. CEO Arvind Krishna specifically noted that this margin growth is the result of, quote, driving productivity across the company with AI and automation.
Wait, so not just firing people?
No, they aren't just hacking away at their workforce to save a buck. They're actually taking their own enterprise AI tools and hardwiring them into their internal operations.
Walk me through what that actually looks like on the ground, like practically.
Think about it like a robotics company using its own prototype robots on its factory floor to build the next generation of robots.
Oh, wow. Okay.
Yeah. IBM is using AI to predict and optimize their physical supply chain bottlenecks before they even happen. They're using AI to write baseline code, scaling their internal software development.
Oh, so they're essentially the guinea pigs for their own product.
Exactly. And they're automating massive chunks of their HR and back office administrative tasks too.
Yeah.
And the experiment is working.
Clearly, if the margins are up.
Right. That 30 basis points of margin expansion means that for every $100 of revenue they bring in, they're keeping an extra 30 cents in pure profit compared to last year.
Which doesn't sound like a lot until you multiply it.
Exactly. When you apply that to $17 billion in a single quarter, you are talking about massive amounts of structural, sustainable cash. It serves as the ultimate proof of concept before they turn around and sell those exact same AI solutions to their enterprise clients.
Well, yeah, because you can't just build the robots for your own factory, right? Eventually you have to sell them to someone else. And to understand how that translates to the wider market, we really have to look at IBM's most profitable sector, which is software.
Oh, absolutely. The crown jewel.
Right. So for Q2, software brought in $7.8 billion, which is a 5% increase year over year. But when you dive into the subcategories, Red Hat accelerated to an 11% growth rate.
Which is fantastic for them.
Yeah, and OpenShift annual recurring revenue hit $2.2 billion. And then there's this category simply called data, which skyrocketed by 18%.
That's the one to watch.
Yeah. What is inside that data category driving that kind of spike?
So management refers to this as their high-growth portfolio. This is really the engine room of the whole AI boom. Enterprise clients are realizing they can't just plug a generic chatbot into their business and call it a day.
Right, you need the infrastructure first.
Exactly. They need tools to manage, clean, and secure their proprietary data before AI can even touch it. That portfolio includes their watsonx platform and critical acquisitions like HashiCorp and Confluent.
I've seen HashiCorp in the news a lot lately, but mechanically, what does it actually do for a client that makes it so valuable?
In the simplest terms, HashiCorp acts like a highly secure traffic cop for the cloud.
Okay.
When a massive bank, or say a huge retailer, uses multiple different clouds like AWS, Google, and IBM, all at once, HashiCorp software automatically manages the passwords, the security protocols, and the infrastructure so all those different clouds can talk to each other safely.
Oh, I see.
Yeah, in an AI world where data is flying everywhere, that traffic cop is mandatory.
Which explains why the software is so sticky. I mean, once you install the traffic cop, you can't just fire him without causing a massive pileup in your data center.
Which brings us to the most critical metric in the entire software segment, total annual recurring revenue, or ARR.
The magic letter.
Truly. Across all their software, their ARR is now a staggering $24.6 billion. That's up 8% since last year.
$24 billion in guaranteed subscription-like revenue. That's essentially an annuity at this point.
It is the holy grail for a corporate balance sheet. Yeah. It represents highly predictable, high-margin cash flow that just compounds over time. It is the financial bedrock that allows management to sleep at night.
And fund all those crazy future projects.
Exactly. It allows them to fund massive, risky bets on future technology without jeopardizing the whole company.
But, here's where it gets really interesting. Because while those new AI and cloud tools are flying high, there is a glaring, ugly negative in the software data.
Yeah, I know the one you're talking about.
The transaction processing category within software is down 9% year over year. I mean, that is a noticeable heavy drop. Are the legacy old-school software systems dragging down the shiny new AI toys?
It definitely looks like a heavy anchor when you just isolate that one number. Transaction processing is essentially the software that runs on IBM's older mainframe systems.
Like the really old-school banking stuff.
Right. This is the technology that processes credit card swipes and airline reservations. It is the definition of a legacy business. And as clients inevitably migrate more workloads to modern cloud architectures, that revenue stream is going to face downward pressure. It's a known gravitational pull on the company.
But 9% down is steep. How do they keep the whole software segment growing at 5% when a huge chunk of it is shrinking that fast?
Because of the margins. Remember how we talked about them using AI internally to become more efficient?
Right, the internal guinea pig thing.
Exactly. Through those productivity actions, IBM managed to expand the profit margin of the entire software segment by 110 basis points.
Wow.
Yeah, bringing it to a massive 32.2%. That means for every $100 of software they sell, they keep over $32 in operating profit.
Okay, so the new stuff is growing so fast and is so incredibly profitable that it just completely offsets the decline of the old stuff.
Precisely.
They are essentially outrunning the ghost of their own past business model. Now, software is great, but the cloud is not magic, right? It is still made of physical metal. It requires massive servers. So let's look at the physical hardware that runs all this, which is the infrastructure segment.
This is an area where looking at a single quarterly number can lead you to completely the wrong conclusion about the health of a business.
I'll admit, the surface numbers look disastrous. Infrastructure revenue came in at $3.8 billion, which is down 7%. But the shocker here is the IBM Z line item, their flagship mainframe hardware.
Yep.
It plummeted by 42%. I mean, a drop that massive sounds like the market just completely rejected their product. How is Wall Street not panicking over a 42% collapse in mainframe sales?
Well, if we connect this to the bigger picture, you'll see why that 42% drop is actually an illusion created by the calendar.
What do you mean?
Mainframe hardware doesn't sell in a smooth, predictable, upward line like software subscriptions do. It moves in these multi-year supercycles.
Okay, kind of like the launch of a new video game console. Like, everyone buys a new PlayStation the month it comes out, sales are astronomical, and then 3 years later, Hardware sales look terrible because everyone who wants one already has one.
That is the perfect analogy, just applied to massive data centers. IBM releases a new generation of mainframe. Enterprise clients spend billions upgrading their systems over the next few quarters, and then sales naturally taper off until the next generation is announced.
Got it.
Right now, the Z17 mainframe is in the market. And according to the report, the Z17 is actually having its best refresh cycle in reported history.
Wait, if it's the best cycle in history, how is it down 42%?
Because of where we are in the cycle. They noted the Z17 is at nearly 130% program to program.
Okay, unpack that.
That means if you compare this exact quarter in the Z17's lifespan to the exact same quarter in the previous generation's lifespan, it is selling 30% more capacity. The 42% year-over-year drop is simply because last year they were at the absolute peak of the initial launch frenzy. It's a tough comparison, not a lack of demand.
That completely flips the narrative on that number. But there is a hidden win in the infrastructure segment that doesn't require any cyclical calendar math.
Right, distributed infrastructure.
Exactly. Distributed infrastructure delivered its best quarter of revenue growth on record, up 37%. And they exited the quarter with a $500 million backlog in power and storage. Why the sudden explosion in storage and power?
Because AI is incredibly physically demanding. It's not just a software phenomenon.
Right, it needs juice.
Tons of it. Training a large language model requires massive amounts of electricity, specialized silicon, and vast arrays of storage to hold the training data.
The heavy machinery of the digital age.
Yes, exactly. That $500 million backlog tells us that enterprise AI demand is not just theoretical whiteboard planning anymore. Companies are literally lining up to buy the physical bricks and mortar required to build their AI factories.
But, you can buy all the heavy metal and software in the world. If you don't know how to wire it together securely, it's just a very expensive paperweight.
That's for sure.
Which brings us to the human element, right? The consulting segment. Because if infrastructure is the pickaxe, consulting is the training manual. Revenue here was $5.3 billion. That is flat, or, well, up 1% if we adjust for constant currency. Again, not exactly a number that screams high-growth revolution.
It doesn't, and management was transparent that they faced some macroeconomic headwinds late in the quarter.
Like clients pulling back on spending.
Right. When companies get nervous about the economy, discretionary consulting projects are usually the first thing they pause. However, while top-line revenue is flat, the actual composition of the work IBM's consultants are doing is shifting at breakneck speed.
Where is the demand shifting to?
Generative AI. According to the slide deck, generative AI initiatives are accelerating wildly. They now represent roughly 50% of all new consulting signings and over 30% of the entire consulting backlog.
Wait, really? Half of all their new consulting contracts are related to Gen AI? That is a massive pivot.
It is. And just like we saw in the software segment, consulting experienced a huge margin expansion. Productivity actions contributed to 160 basis point expansion in the segment profit margin, pushing it to 12.1%.
Oh, wow.
So for every $100 of consulting billed, they are keeping an extra $1.60 compared to last year. Flat revenue, but significantly more profitable revenue.
There is a term in the press release under this consulting section that really caught my eye, and I want to dig into the mechanics of it. They talked about investing in specialized talent, specifically mentioning forward-deployed engineers.
Oh, yes.
To me, that sounds like a military term. It sounds like a special ops tech team. What does a forward-deployed engineer actually do?
The military comparison is actually quite fitting because the current landscape of enterprise AI is something of a minefield. Right now, every board of directors is demanding AI integration, but very few companies know how to do it safely.
Because it's one thing to play with a chatbot, right?
Exactly. It is very easy to play with a chatbot on your phone. It is incredibly difficult and dangerous to connect a large language model to a global bank's proprietary customer database.
Yeah, because if the AI hallucinates or gets confused, it could leak secure HR data or crash a supply chain or give terrible financial advice to a client.
Precisely the fear. Many companies are stuck in what we call pilot purgatory.
Pilot purgatory, I like that.
Yeah, they run a safe, isolated AI experiment. It works great, but they are too terrified of security risks to actually deploy it into their live daily operations.
So these forward-deployed engineers are the solution to pilot purgatory.
They're the bridge. IBM is sending these highly specialized engineers on site to physically or virtually embed with the client's internal tech teams.
Like a SWAT team.
Right. Their mandate is to take AI out of the sandbox and actually hardwire it into the enterprise's daily operations securely. They're the ones navigating the legacy code, building the guardrails, and turning the theoretical promise of AI into an operational reality that won't break the company.
It's a brilliant ecosystem play. I mean, you
Mhm.
sell them the hardware, you sell them the software subscriptions, and then you embed your own engineers in their building to make sure they actually get a return on their investment.
Which guarantees they keep paying for the software.
Exactly. Now, all of this, the margin optimization, the massive 24 billion in recurring software revenue, the strategic consulting it is generating billions of dollars in free cash flow. And the report shows IBM is funneling that cash directly into some massive, rapid innovation bets.
This is the ultimate payoff of the structural rebuild. They aren't just defending their legacy turf anymore. They are aggressively attacking the frontier of computer science.
There are two specific innovations from the source material that genuinely blew my mind. First is a tool called Lightwell. This is a new open source security capability they rolled out. The stat in the report is that in just its first 2 weeks of availability, Lightwell delivered over 7,500 open source patches to help clients secure vulnerabilities.
It's an incredible number.
How is it mechanically possible to write and deploy 7,500 security patches in 14 days?
It is not humanly possible, and that is the point. Lightwell demonstrates how IBM is using AI to fundamentally change the speed of cybersecurity.
So the AI is writing the patches.
Yes, the AI is trained to constantly ingest massive codebases, instantly recognize the patterns of a security vulnerability, write the necessary patch code to fix it, and deploy it.
That is wild.
They're taking theoretical AI capabilities and turning them into deployed products that solve immediate critical pain points for chief information security officers.
It's like an autonomous immune system for enterprise software. But as impressive as that is, it is nothing compared to the ultimate moonshot buried in this report: quantum computing.
Oh yeah, this is the big one.
Right. In May, backed by the U.S. Department of Commerce, IBM announced a letter of intent to build Andron. This is going to be the world's first pure-play quantum wafer foundry. And the financial commitment is staggering. A $10 billion investment in quantum over the next 5 years. Why do they need a specialized $10 billion foundry? Can't they just make quantum chips in the same factories that make standard silicon chips for our laptops?
Not even close. Classical silicon chips operate on electrical currents representing ones and zeros. Quantum bits, or qubits, operate on the principles of quantum mechanics. They can represent complex probabilities.
Right, the whole Schrodinger's cat thing.
Exactly. To make a qubit stable enough to perform a calculation, you have to build chips using exotic superconducting materials that only function at temperatures near absolute zero.
Wait, how cold is that?
Colder than deep space.
Wow, so you can't just bake that in a traditional silicon oven in Taiwan?
You cannot. The manufacturing process, the materials, the testing environment, it all has to be invented from scratch. That $10 billion investment is IBM signaling that quantum computing is moving out of the physics lab and into commercial manufacturing. They are building the infrastructure to mass produce the future of computing.
So what does this all mean? When you take the disciplined margin cutting we saw in segment 1, the sticky AI software boom, the massive hardware backlogs, and these $10 billion future bets, how does management synthesize all of this into their immediate financial outlook for the rest of 2026?
It translates to an incredibly high degree of confidence from the C-suite. Despite the broader macroeconomic noise that slowed down their consulting revenue, management actually raised their full-year constant currency revenue growth expectations to the 4 to 5% range.
Which is a steep acceleration from the 1% growth we just saw in Q2. They are essentially promising the market that the back half of the year is going to be significantly stronger.
Furthermore, they expect to deliver 100 basis points of operating pre-tax margin expansion for the full year.
So that's a full extra dollar of profit for every $100 they make, sustained across the entire year.
Yes, and perhaps most importantly for retail investors tracking the balance sheet, they are strictly adhering to their promise of generating $1 billion in extra free cash flow year over year.
And since they generated $4.8 billion in the first half, they're sitting pretty.
Exactly. They are well on track to hit those targets.
Okay, let's bring this all together. We started with the mission of cutting through the jargon to see if IBM's AI pivot is a real cash-generating reality or just corporate construction noise. And looking at the mechanics of this report, the narrative is undeniably clear.
The numbers don't lie.
They really don't. IBM is navigating the natural decline of their legacy systems by intensely optimizing their margins with their own AI. They are capitalizing heavily on the Red Hat and data software portfolios, building massive physical hardware backlogs, and using those forward-deployed engineers to conquer enterprise AI deployment. And they're funneling the resulting billions into literal world-building investments in quantum computing.
And for you listening, whether you are an active investor holding tech stocks, an engineer tracking industry trends, or just someone trying to understand the reality of the AI boom, this report matters.
It really does.
It proves that the enterprise shift toward AI is no longer just a buzzword discussed on earnings calls to juice the stock price. It is physically manifesting on the balance sheet. It's showing up through structural margin improvements, massive hardware orders, and a total reshaping of how consulting works.
This raises an important question, though, one that extends far beyond a single quarter's numbers. IBM noted they are remaining stubbornly on track to deliver the first large-scale, fault-tolerant quantum computer by 2029.
Right, just 3 years away.
And with that $10 billion foundry investment, they are building the factory to manufacture it. If they succeed in unlocking commercial quantum computing by 2029, will the massive, world-changing generative AI boom we are living through right now look like just a minor stepping stone compared to the total economic disruption that quantum will bring?
That is literally a $10 billion question.
Something to keep in the back of your mind the next time you hear someone say AI is the final frontier of tech. We might just be getting started. And hey, if you want to stay ahead of the curve on all the numbers that actually matter, make sure to follow the show for our daily earnings coverage. We break down the realities behind the hype every single day.